Something I get asked often, and this has been a recurring question over the past few years, is when is New Zealand going to catch up? And I still can't answer it. Not much use to anyone. But what I will say is it does feel like we're getting back to our baseline level of earnings. So we've been quite bearish on New Zealand relative to global assets over the past 24 months especially. Our next move might actually be to close some of that underweight to New Zealand. And there's two reasons for that. One is that valuations relative to global share markets are actually a lot more attractive today than they were a couple of years ago. And secondly, we feel like we've got a lot more faith in what the earnings picture is going forward. Yeah.
Because I think it's basically, if you look pre-COVID to today, the index is almost flat. I mean, depending on the day, it might be up 1% or 2%. You think surely that can't last? Yeah,
I mean, but I always tell people that, be careful with time frames because, that's true. So I think to the end of 2019 to today, we're pretty much flat. And the US market's up like 70%.
Yeah.
So it's been a massive drain, and you look at it and go, "What am I doing here? Why am I investing in New Zealand?"
That's why I have this episode.
And I think there's good reasons though too, and just on the performance basis. So the 2 decades to 2020, we outperformed the US market quite substantially.
Right.
So from 2010 to 2020, the indices were pretty much on par. But the US from 2000 to 2010 was flat because we had 2 crises. One to do with tech. The other was obviously the global financial crisis. And that's the good thing about New Zealand. Our companies weren't impacted as much. We hummed away. And actually, we delivered the level of outperformance, which is similar to what the US has delivered relative to us. Over the past 4 years that we've just talked about. So, yeah.
So that's why we talk about this whole, you got to have a long-term horizon and you got to be prepared for losses. 'Cause, I mean, some of us are, younger investors who definitely haven't been around for any 10-year cycle, let alone multiple. But it's interesting to hear that, like, this idea, because to me, 3 years of flat gains feels like my investing lifetime.
Yeah.
But it's interesting to hear that there was a time where there was 10 years in the States.
But there can be some very, very long winters. So we're talking about Japan this year, right? Because the Japanese stock market has done really well. The problem with the Japanese share market all-time high is the high that they hit this year was relative to 1989.
Okay, all right.
So it's 35 years, in other words, of a zero nominal return. We're not even talking about kind of real adjusted returns. Look, I'm not going to draw that analogue to today in the US, like the valuations in Japan were just absolutely unheard of, and they haven't really been tested since on a price to earnings multiple basis. The only thing close was the tech bubble in the US, but it's just a really good example of conventional wisdom back then was Japan was the future, and it didn't transpire. Interesting with Japan today, it does look like. And a key reason their market has rallied is one, there's reforms around shareholder returns. So, Japanese companies were quite benevolent and really took great care of their employees, which is a good thing.
Sounds nice.
But would do expenditure with expectations of really low returns on capital.
So, if Japan is being a little bit less benevolent, is the reason the US economy and therefore its share market to a certain degree is outperforming because the US is not so benevolent? Perhaps they're better capitalists, perhaps more malevolent, you might even say?
There is some truth in that. If you look at the share of a company's profit that goes to labour versus what goes to the shareholders, that is over the past couple of decades in the US fallen. So a bigger share of the gains have gone to capital over labour. More nearer term, what's quite interesting is that some of the larger companies in the US, you'd probably say they weren't great capitalists. So, and I'm talking specifically about some of the large tech companies. So, going into the, say, 2020, 2022, they had a decade of just really, really cheap money, easy to get around away, with regards to raising capital. And money was cheap, right? We had interest rates at pretty much zero. And that meant that actually there was a lot of fat in those businesses, right? Think of Meta. Think of why it's called Meta, because they were chucking so much money into the metaverse, and it wasn't exactly delivering any shareholder returns. So actually part of the gains that you've seen in the US share market, I think, particularly in 2023 and 2024, has actually them being better capitalists. So I'll use Meta as an example again, because they've managed to deliver strong profits while reducing their workforce.
So I feel like we've highlighted two main things that explain the difference between the New Zealand, Australian markets and the Japanese and US markets, which is largely tech exposure, AI, better economy performance. How would you split those two things? Is it 50-50, or is it more tech driving the returns, or is it more the better economy? Do you have an idea of which of those two things are having a bigger impact, I guess?
It's definitely the composition of an index which has the lion's share of the impact, in my view. And the reason I say that is because we do a lot of analysis where we adjust share markets to have the same composition as the US and see how much of returns that actually explains. So it does explain a really large portion. So for example, if Europe had more in information technology, just the same information technology companies they have today, their share market return would be higher because their information technology sector has actually done quite well, but they just haven't had as much of it as the US. So that definitely is the lion's share. And so some of it's sector, some of it comes down to style as well. So, growth investing has done quite well for a number of years, particularly though kind of over the past 12 to 18 months. Now, when you look at a lot of the companies within New Zealand, for example, you wouldn't call them traditional growth.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.